Hello, I'm Kelly O'Byrne and welcome to LCG's preview for the week ahead. I'll be talking to our head of research, Jasper Lawler, to discuss the fallout from the strengthening US dollar, specifically a weaker Chinese yuan, a drop below 130 for the British pound, and a one-year low in gold. We also look ahead at the ECB monetary policy meeting. Before that, I'll run down some of the top corporate results to watch for this week. So it's Ryanair and Google parent Alphabet reporting quarterly results on Monday. Peugeot, UBS, Fevertree and Hammerson report half-year numbers, while 3M, United Technologies, Verizon and AT&T report second quarter results on Tuesday. ITV and GlaxoSmithKline report half-year numbers, while Deutsche Bank, Banco Santander, Coca-Cola, Boeing, AMD, Qualcomm, Visa, Facebook and PayPal report quarterly earnings on Wednesday. Then it's Airbus, Anglo-American, Total and Sky reporting half-year results, while Royal Dutch Shell, Spotify, McDonald's, Intel, Starbucks and Amazon announce quarterly numbers on Thursday. And finally, BT, Twitter, Exxon and Chevron report second quarter results on Friday. Now, moving on to the economic calendar, it really gets going on Tuesday when we have manufacturing and services PMIs for both Europe and the US. On Wednesday, it's Australian CPI and German IFO. Thursday is the big one with the ECB monetary policy decision as well as US durable goods. Then on Friday, it is the latest update on US second quarter GDP and US personal consumption. So Jasper, the rise in the dollar is getting interesting.
Well, it is, Kelly, just because of the effect it's having in other parts of the market. So we look at gold hitting its lowest in a year, the pound dropping below 130, also the Chinese yuan hitting its lowest in a year. Obviously, they're all traded against the dollar in the case of gold denominated in dollars. So that's the theme, that's the backdrop. This latest leg lower, largely down to Jay Powell, the Fed chair, showing his confidence in the US economy when he was at in front of lawmakers in the US. So it looks like those 4 rate hikes are almost a dead cert. And then the backdrop to that is that clearly the Fed feel fairly confident that the tax cuts are going to boost the US economy sufficiently to outweigh any kind of risks on trade. And I'd probably go along with that to say that, well, it's the US are looking to cut their trade deficit, right? So it's the other countries that stand to lose. Hence, you're seeing these gains in the dollar for multiple reasons. So again, it's rippling out to other markets. It remains to be seen whether it actually causes some sort of major flows or market difficulties in some way. It's possible.
Okay, yeah. And now the move in gold is particularly interesting, given that you think the trade war would mean that it would be a safe haven.
Well, exactly. And I think that, sort of flipping that on its head, the fact that hasn't played out as a reason for gold to get supported is why we're really seeing it drop quite sharply now, because, you look for gold as a haven, it doesn't work, it falls alongside all the other assets, arguably does worse than equities, which are a riskier asset. When there are these trade tensions, eventually you give up the goose. And I think that's kind of what we're seeing at the moment, a bit of capitulation in gold. We're heading down to that 1200 round number. So perhaps we start to form a base around there, because part of this is seasonality. Typically gold not too popular in summer months, but you head into Indian wedding season, physical demand picks up a bit. So maybe that can be the basis for some sort of short-term bottom, but it seems like the inherent demand for it is a haven, especially when it's denominated in dollars, which are doing so well. It's a difficult environment for gold.
Mm-hmm. Yeah, and the pound back below 130 as well.
Yeah, another symptom of the dollar as well, but obviously the pound got its own effects. Theresa May just about hanging on the premiership, basically trying to cling on until the summer recess. It looks like she probably will. She's got through a number of votes, but clearly, even though the votes have been passed, she doesn't really have the full support of her cabinet, and you've obviously seen those big resignations. I wouldn't be surprised to see a little bit more Brexit turmoil even over the summer when Parliament's broken up. So you can see for the reasons of uncertainty over Brexit, no deal Brexit looking a lot more likely than before. And just last week we had 3 points of disappointing data. It was the retail sales that sent us below 130. Probably all that adds up to the Bank of England not hiking rates in August, or at least the chances of it are a lot more reduced than they were just even a week or so ago.
Mm-hmm, okay. And the ECB meeting coming up, do you think that could change the fortunes of the euro, which also has been pretty soft versus the dollar?
Yeah, I suspect probably not. The big message was last month, was in June, when they said they announced the end of the QE program. And so I think July will be more about just reaffirming that same message. Sort of, they did in a way stick their neck out a little bit, because it's far from certain that growth in Europe is actually just temporarily dipping, and rather than just permanently going to a period of weakness. And inflation, headline inflation's up above 2% again. So that is obviously a big reason why they can feel confident, but it's largely oil prices. So if you look at core inflation, which strips out food and energy, it's below 1%. Doesn't really suggest much underlying inflation, a reason for hiking rates. So they need to kind of double down on their message, because actually when you look around them, there's not much justification for, maybe there is for tapering, but not for hiking rates very imminently afterwards.
Okay, great. And just before we wrap it up, let's go to earnings. There's plenty coming up. What will you be watching out for?
Well, you always have to go to big tech giants, right? Especially Facebook, obviously been an interesting quarter for them. So last time we were speaking, it was just as the scandal had broke, and it hadn't really had any impact on their earnings, but there'd only been a sort of couple of weeks of possible impact. This time we've got a whole quarter, so maybe there is been some detrimental effect on their advertising revenues, or user growth, monthly users, etc. So definitely more risk in the Facebook shares than normal, but they're trading up near record highs at the moment. So clearly it's not the default expectation. And then Amazon has just been rip-roaring. Obviously, ever since really it bought out Whole Foods, and there's this sense that they're just taking over the world. I saw some statistics saying that Amazon represents 48% of US online orders. So they're just absolutely dominating right now. So you'd expect another stellar set of results, but they are priced to perfection. So if they're not, again, you get volatility either way.
Yeah, of course. Thanks, Jasper. And thank you all for watching. If you wish to get these videos as soon as they're released, please follow LCG on YouTube and social media.